You've got World Bank downgrading the global growth by 0.2%. Where do you think we're heading for 2020 when there's so much pessimism within guys who are running money for their companies?
Well, so CFOs are notoriously pessimistic or cautious, so I would discount that a little bit. Also, it's a question of when you ask the question, because over the last 45 days, we've seen a lot of positive developments. Our base case scenario is that trade turns out pretty decently, global growth picks up slightly compared to previous estimates, and earnings come in fairly strong for 2020 because comparisons to 2019 are relatively easy. So we see high single-digit returns for the year in equities. But we do favor staying relatively defensive, or at least sticking with higher quality names where you've got strong earnings visibility, margin expansion, and ideally also taking market share away from competitors.
Eric, what do you think about this survey and the fact that it's not just about the economy slowing, but also that the stocks are overvalued? You heard Bob Pisani there just talking about how dramatically we've seen this multiple expansion over the last year or so. Where are you seeing 2020 in the portfolios?
We do have some optimism about earnings for 2020. Agreed that last year was really more of a flat earnings environment, but multiples expanded. We do think you're going to see some revenue growth, not just domestically, but also internationally. The biggest edge that we think we have is looking at data across the globe. And one of the things that we see is really an improvement in parts of Europe and most pronounced in emerging markets. That's different from this time last year. So we do think that this is likely to be still a single-digit type of growth environment, but still a healthier one than last year. So we're a little more optimistic. I also would just say that in terms of that survey, if you look at Duke University's CFO survey, if you look at the National Federation of Independent Business survey, both are more constructive, especially in the last 45 days. So there's reason for some optimism on the CFO front as well.
Oliver, given your relatively constructive view of the market for 2020, where would you put money right now? What kinds of stocks, what names?
So we like companies like Bristol-Myers Squibb, who Bristol-Myers acquired Celgene, so you've got some earnings growth potential. They effectively bought their way out of declining sales growth, and we think that's a good place to be. Companies like Intuitive Surgical, that's basically a decade ahead of their competitors. We think that robotic-assisted surgeries are going to continue to grow exponentially over the next years, and they're very, very well positioned. Another name that we really, really like is Adobe. Adobe has moved to a subscription model. They essentially become a one-stop shop for marketing, and it's just a terrific cash flow business going forward to us. So it's companies that, again, have strong balance sheets, have strong visible earnings growth, are taking market share from their competitors, and whenever possible, fall into the category of what we call compounders, where there's a dividend growth component, where there's share buybacks, things that allow investors to compound on the growth beyond just earnings growth.
And Eric, what about you? Are there particular sectors that you like right now, and how do you see the domestic opportunities versus, say, emerging markets?
We think that from a sector perspective, looking at the CFO survey and also just what CFOs are doing, we think that technology remains the place to be for investors. And we also think that in terms of the non-U.S. picture, we're really warming up to emerging markets. It's a space that really did not hit highs and actually has not made new highs since January of 18. So do think there's some more upside there, but we do think that from a secular standpoint, technology makes sense. Also, for those looking for more income, we think that mortgage REITs are also interesting at these levels.